Should you be buying a new or an old property in 2025? Now, this is one of the most debated questions in Australian property investing. But here at Liviti, we have an entire research team whose sole job is to cut through all the noise and make data-led decisions, not chasing headlines or any of the hype. If you've spent any time in property forums or even spoken to a couple of buyer's agents yourself, you've probably heard a couple of things about new property. How new properties are overpriced, how they underperform, and the fact that they only benefit developers and are way too expensive. And truthfully, that concern doesn't come out of nowhere. We've seen examples where people have bought new builds in oversupplied areas that underperform, whilst other properties that they've looked at have boomed. But here's the thing, most of these arguments rely on generalizations that ignore strategy, context, and most importantly, location. So it's no surprise that criticism comes from groups who don't deal with new builds, like buyer's agents and advocacy firms. It's not bad faith, it's just what they know and sell on a day-to-day basis. But today, I want to unpack what the data is actually showing us and what most people overlook. In this video, we'll cover when do new builds underperform and when do they outperform. What really drives capital growth when it comes to property? And is the price markup as bad as what people are saying? Hello everyone, my name is Luke Cheng, Head of Research here at Liviti, and as both a researcher and a property investor myself, I've worked extensively with both new and established properties that benefit my portfolio as well as our clients. If you're new to Liviti, welcome. And if you've seen a couple of past videos, you'll know that we're all about breaking down data, understanding strategy, the fundamentals of finance, so you can make informed, confident decisions today. So let's get into it. The first thing we want to discuss is why location, not age, drives capital growth. So let's start with something simple. The broad statement that buildings don't drive price growth, the land does. New builds have gotten a really bad rap, part because of stories like Pimpama up in Queensland, which in early 2010s, developers pumped out way too much supply in that market and it took years for the demand to catch up. But it wasn't the newness of the homes that caused the poor growth. It was poor planning, weak infrastructure, and investor-heavy demand. A big portion of this area was heavily investor-focused. And here's the twist. Pimpama didn't stay down for long. Fast forward to today, it's one of the best performing suburbs in the entire southeast Queensland corridor. Now, there were over 600 houses that sold in the past year, all taking 20 days or less to sell. So what changed? Infrastructure changed. So let's take a look. New railway stations due in 2025, new schools, new shopping centres, and a surging population that's really transformed that whole suburb's fundamentals. So yes, Pimpama struggled early, but the long-term fundamentals eventually kicked in. It caught up and then added some extra growth on top of that. We saw a similar situation in a lot of the parts in Western Sydney, especially during the mid-2010s. Suburbs like Gregory Hills, Oran Park, all had large volumes of land release at once. Investors and owner-occupiers piled in, attracted by incentives and low entry prices. But competition was fierce, and property price growth stalled for a few years until infrastructure caught up, and the owner-occupiers later balanced things out. In fact, the numbers show this story clearly. In Gregory Hill, price stagnation in the first few years happened because of this extra supply. But most recently, median house prices have risen to over $1 million. Oran Park had a similar trajectory. Initially, the growth was slow, but now the median house price sits around $1.1 million. And that area has continued to develop into a vibrant family owner-occupied suburb. When fundamentals like infrastructures, schools, owner-occupied demand continue to improve, the capital growth often catches up in these markets. A common critique is that new builds are marked up, meaning you're paying more than what the property is actually worth. And the reason people think that is to cover costs like flashy marketing, sales commissions, all of these things that developers typically are known for, right? Yes, developers do outsource sales and marketing to sales firms. And yes, they do add that cost back into that project. But what most misunderstand is that it doesn't automatically mean that the price is inflated beyond fair market value. So think of it this way. Banks don't hire thousands of staff to sell loans directly to you. They use mortgage brokers. But what you don't say is, hey, the loan is overpriced because someone was paid to help you get there. Or take airline tickets. You can book directly with the airline or you can go through a travel agent. Either way, the final price already includes the cost of customer acquisitions. We accept that in a travel or banking scenario that it's completely fine. So why treat property any different? When you buy a new property, a bank-appointed independent valuer still decides whether or not that price stacks up. These valuers do not represent the developer. They don't get a cut of that sales commission. So yes, there are risks. The risks are always real when buying any asset in the wrong location, with no plan whether or not it's old or new. Part of our philosophy here at Liviti is not to use blanket statements because they simply don't work. A lot of the argument regarding established is better than new are based on comparing apples to oranges. Usually an old home in a premium suburb versus a brand new place in a greenfield area. Now that to me is not a very fair comparison. Comparing new and old properties without context is like comparing any investment just by the age. It tells you nothing about what actually matters. An old property might give you more land, give you the chance to renovate and force equity in that position, but it can also come with higher maintenance, more tenant churn, and less tax depreciation benefits. A new build, on the other hand, might be easier to rent, attract higher quality tenants, and qualify for depreciation benefits that help you in that cash flow scenario. So each have their pros and cons, but both can work. But here's the thing, not every investor has the time, risk appetite, or experience to be doing renos, subdividing blocks, right? Maybe you're an emergency doctor working 100 hours a week, or a busy professional who doesn't want to deal with the weekend emergencies of broken plumbing. For those people, a new build in a well-researched area might be the smarter, more hands-off way to be building long-term wealth. So no two investors are the same. So instead of asking, hey, which type is better, ask which location has a good pipeline of population growth? Local jobs, infrastructure, schools, are they improving? Is it at a price point where I can actually afford? And how much will this property cost me over time? These are the questions of smart investors who focus on questions that drive performance, not whether or not it's brand new or 40 years old. All right, so let's now talk about something that rarely gets covered in flashy property headlines, right? Which is how much a property actually costs you to hold. Because sure, capital growth is great and it's important and you can forecast it and it's all fun and dandy, but when it comes to leaking money through high maintenance, vacancy, tax rate inefficiency, it does not matter how much that suburb grew, your returns will still suffer at the end of the day. So let's break this down properly side by side. If you're building from scratch or buying a house and land package, yes, you need to cover interest repayments whilst that property is under construction. And worse yet, you're not even earning any rental income during that time. Now, naturally, this alone will scare off most investors even considering this as an option. But here's the truth. Most people don't actually know how much it costs or what the real impact is. So let's take a moment to break this down. When you take a step back and you calculate the total interest during that entire build period, this is something you need to budget for. So if we take a look at a 10-month build period, we're looking at $16,000 total all up. Now, here's what's often missed. In many cases, these holding costs are actually outweighed by the total savings you have in stamp duty. For example, by purchasing an existing property, even if it's a day old, you'll be paying $27,700 in stamp duty alone. That exact property, if it was brand new, and I must emphasize this, you'll only be paying $7,800 in stamp duty. That is a $20,000 instant cash savings on stamp duty alone. Coincidentally, it's actually more than what you have to pay on the interest when you build. Yet no one talks about this very fact. So to summarize, it's actually, when it comes down to the numbers, exactly the same whether or not you are buying new or existing. It's whether or not you want to be paying interest to the bank or straight up upfront cash to the government. A lot of people stress about delays when they're building a house. But what you need to know is that delays, if they do even happen, occur when land is getting approved, not during the building of the property itself. So when land is delayed and being prepared, you don't have to pay a cent. So for most investors, because you don't have to pay anything during that period, and you've locked that price in from day one, you get all the benefits of time whilst your property gets prepared. So let's take another perspective and explain this in a different way. If you were a developer, sold a property, and are now waiting months for government approval, all whilst properties around you are increasing in price, would you want to cancel the initial contract and resell it at a higher rate? If I was a developer looking for money, that's exactly what I would be doing. This is the exact reason why the New South Wales Supreme Court recently introduced tighter regulations on sunset clauses. So developers do not have the ability to cancel contracts, allowing them to resell at a higher price. We know this only because we are members of the MBA and Law Society. So when we look into these buildings, look into these contracts, we know exactly what each line of these items mean. Lastly, I can tell you that being on the ground myself, building delays rarely occur, especially after COVID. During COVID, you can argue that costs were higher, people weren't able to go to the site, but now that's rarely happening. Once land is ready, builders want to finish just as fast as you do because they're paying for workers, they're running up costs, and it's in their best interest to wrap things up quickly. It's not in their interest to drag their feet. Like all industries, there are good and bad eggs. Developers are no different. That's why it's always important to pay yourself with a good vendor that has a good track record and also, in our case, guarantees a 6-month build contract. Now, let's move on to rental yield. A brand new home often will rent for a little bit more. They've got better modern layouts, more efficient energy, ducted heating, maybe even some solar panels. In Tani, for example, a brand new 4-bedroom home might rent for $520 a week. A 20-year-old home just down the road, $400 per week, and probably needs a few more renovations to attract that exact same tenant. When it comes to maintenance costs, new builds, minimal. Builder warranties typically cover for 6 to 7 years and everything's new, so it's not much that's gonna go wrong. Expect to pay around $200 to $500 per year. Older homes, $2,000 to $5,000 in maintenance is common. And if it hasn't been renovated yet, expect to spend around $20,000 to $50,000 in upfront costs just to make it rentable. When it comes to depreciation benefits, new build gives you full deduction under Division 40 and Division 43. In layman's terms, it means you're able to claim $10,000 to $15,000 every single year in tax benefits. Established homes, not much unless it's heavily renovated, and even then, those deductions reduce really quickly. The depreciation clawback myth. Yes, depreciation reduces your cost base and increases your capital gain when you get to sell. But it's not dollar for dollar. You're taxed only on 50% of that gain, and you get to keep all the early year tax savings in the meantime. So in many cases, you'll save anywhere between $30,000 to $40,000 across the first few years, but pay $7,000 to $8,000 more when you actually decide to sell. You still come out ahead. Now brings us to vacancy risk. Modern homes always rent faster. Tenants simply want clean and low maintenance homes. Older stock, you risk having to sit empty for a little bit longer, or having to drop that rent in order to get that tenant back in. So what does all this mean? Less downtime, better cash flow. So having something that can attract tenants to come in from day one, stay in for longer, is the key when it comes to maintaining that cash flow. Now brings us to land tax. Everyone wants bigger land, and a lot of the time, people don't realize that you actually have to pay every single year by doing so. If budget is a concern for you, smaller land means lower tax, more efficient land to asset ratio, and ultimately better cash flow. So it's not about what's better, it's about how a property can serve your strategy and your plan. All right, let's not now pretend that new builds are always the better option, because they're not. There are absolutely situations where older homes can win, especially if it's the right type for you. Let's break this down. If you're someone who wants to renovate, maybe add a bedroom, open up a floor plan, modernize a kitchen and bathroom, an established property gives you that flexibility. You might also get a larger block of land or a better position in a suburb that's already matured. Some established homes sit on 600, 700, or even 800 square meters that open up the door for granny flats, subdivision, or just long-term land banking. So when does older make sense? If you're experienced and have the time to manage renos, you're buying in a tightly held area with no new land supply. Or if you've got capital to actually spend on all of these things that you want to do. These are the situations where it might make sense for you. But here's the flip side that most people often miss. This strategy takes a lot of time and skill, and usually it requires a large cash buffer. If you're time poor, risk averse, or just starting out, this might not be the best first move. Some people love the challenge. Others just want a clean and simple asset that grows quietly in the background whilst they live their life. That's why whatever you end up investing must align with your personality and your lifestyle, not just numbers on a spreadsheet. So, should you buy new or established? Hopefully, now you understand that it's the wrong question to ask. The better question is, what's best fit for your goals, your borrowing capacity, and ultimately your lifestyle? If you're time poor, want predictable returns, and prefer low drama, new builds in a growing suburb with tight supply might make a lot of sense. If you've got the time, skills, and capital, and you love getting your hands dirty, then maybe older stock with renovation upside is your game. But whatever you do, make sure you're asking better questions than simply which type is better. Instead, ask what growth profile is in that suburb, what the supply and demand story is, what local rent's doing, and who lives there. But most importantly, can I comfortably afford to hold this property through this cycle, and can I see the numbers? Because that's the stuff that truly matters. Now, to be completely transparent, we do recommend new builds for a lot of our clients when it's the right fit. If it suits their strategy, their budget, their timeline, and risk profile. And best of all, we'll show them what's available along with the numbers. But this is really important because we disqualify 95% of the builder stock that we see, because most of it doesn't meet fundamentals that we're talking about today. We're not interested in overpriced, poorly located, or oversupplied products, and neither should you. Now, if we're being idealistic, the perfect scenario would be buying a brand new property in a proven growth location that has the dream combo of strong land value, tight supply, zero maintenance. But here's the reality. Those opportunities are rare. And when they do exist, they're usually priced well into the millions. This is why many of the affordable new builds tend to be further out, in fringes or in growth corridor suburbs. These are not the second best. They're simply what's available for most people's budgets. And if you're getting in the right location and time it perfectly, you can still deliver strong returns with far less complexity. So to put this to rest once and for all, if you can purchase a brand new property cheaper, if not the same price as neighboring properties with the same land value, then does that make sense for you? It's not about commissions, it's not about agents, right? If it's the right price for your strategy, then that's the property that benefits you the most. So next time you hear someone saying, never buy new, or old is always better, just smile, keep on walking. You've got a full picture now, and that puts you ahead of most investors. So if you need help finding the opportunities, I've left a few links below for you to check out and book in a time with us.